Now, these days, there's so many different ways to invest into Australian shares. You can buy individual companies, you can invest into a listed investment company, a managed fund, or an ETF. And in this video, I'm going to be looking at the strategy that I've found that beat 90% of the professional funds, the LICs and the managed funds over the last 5 years. And so I've crunched the numbers on 350 different managed funds, all available for anyone to find and see on the Morningstar website. These are all fund managers tracking the Australian market and benchmarked against the broad Australian index. And what I found is that 90% of these fund managers underperformed a simple ASX 300 ETF over the last 5 years. That is the Vanguard ASX 300 ETF that we recommend to StockSpot clients, and we have for 10 years. It's done significantly better on an annualized basis over 5 years. In fact, if you were invested into that ETF, you would have made about 1.2% per annum, more than the average fund manager, and therefore $100,000 invested 5 years ago would have led to $12,000 more profit in the ETF versus investing into one of these managed funds. So why is this the case? Well, although there are some fund managers that have correctly picked the right stocks to be invested into and the ones that have outperformed, most unfortunately haven't owned the best performing stocks. And over the last 5 years or so, banks have been one of those sectors in Australia. And it's not a sexy sector. It's not a sector a lot of fund managers really like to spend a lot of time on, but Australian banks have actually performed pretty well. And so if you've owned the broad market index, you've got exposure to banks in the proportions that they're in the index. And there are also a bunch of other companies that have grown very well and become a bigger and bigger part of the index, helping the ETF perform well compared to a lot of managed funds. The other reason is just the maths of fees. So the ETF itself charges less than 0.1% per year. Most fund managers in these managed funds charge more than 10 times that amount. And that becomes a huge hurdle that they have to beat year after year after year in order to beat the ETF. And over periods of 5 or longer years, it's almost impossible for most of them to do that. And that's the reason why at StockSpot we exclusively recommend ETFs to clients. Although you could get lucky and pick a managed fund that beats the market, the math simply doesn't work in your favor over the long run. We prefer low-cost, diversified ETFs that track the whole market. And over the last 10 years at StockSpot, they've been proven to give more consistent performance versus other ways of investing like picking stocks or managed funds. And the latest data shows exactly this as well.